Hello and welcome to this series on accounts fundamentals, which is, in my opinion, a prerequisite for the new business dilemma. Let's start off by looking at the three financial statements that we have. In this video, we will look at the layout of the balance sheet and the double entry method of recording transactions. When I talk about the layout of the balance sheet, it means you will get insight into assets and liability, their classification. We'll talk about the shareholders' equity together with retained earnings as well. Financial statements are records of the financial activities of a business, and there are three main financial statements: the balance sheet, the income statement, and the cash flow statements. So we are going to start off by reviewing the balance sheet, which is also known as the statement of financial position. The balance sheet shows what a company owns, referred to as its asset, what it owes, referred to as liability, and what it is worth, referred to as equity at a particular point in time. The income statement, also known as the statement of profit or loss, shows what a company has earned as revenue, what it has paid as expenses, and what the resulting profit or losses are over a certain period of time. The statement of cash flow or the cash flow statements show the actual cash movement in the business. It shows how much cash a company has brought in or how much it has paid out, organized into three categories: cash from operating activities, cash from investing activities, and cash from financing activities. In order to understand the layout of the balance sheet, we need to define some terms. Let's start with the assets. Assets are things that a business owns, such as cash in the bank, furniture in the office, equipment, and the technology used in the production of goods and services. And there are two classification of assets. The first is the current assets. These are assets that are expected to be used within 1 year time, and they include things like cash, inventory, and accounts receivable. The second category is non-current assets. Now, non-current assets are expected to last more than a year's time and include things like property, plant, and equipment, technology, patents, trademarks. Non-current assets are typically grouped into tangible and intangible assets. Tangible being those that are physical, like property, plant, and equipment, and intangible being those like patents and trademarks, which are intangible. By totaling the current assets and the non-current assets, we arrive at the total assets of the business, which forms the left side of the balance sheet, which should at all times equals to the right side of the balance sheet. So on the right side of the balance sheet, we also have two categories: the liabilities and shareholders' equity. The liabilities are what a company owes. And just as with the assets, these liabilities are broken down into current liabilities, those that are due within 1 year's time, and non-current liabilities, those that are due in more than a year's time. So by adding together all of the company's current liabilities and the non-current liabilities, we arrive at the total liabilities on the balance sheet. The shareholders' equity section is what the business is worth after all liabilities have been paid off. At the beginning of the business, the shareholders' equity is equal to the amount that was initially invested in the business. Now, the investors get share capital in exchange to providing money to the business, which over time can go up or down depending on whether a company makes a profit or a loss. If a company makes a profit, that net income flows into the equity side of the balance sheet as retained earnings. And this can stay in the balance sheet or it can be paid out to shareholders as dividend, which reduces the retained earnings. And if a company makes a loss, retained earnings also reduces. So retained earning is just a running total of the profits generated by a business, less any dividend paid and less any losses made. At the end of the day, the shareholders' equity must equal total assets minus the total liabilities. We will be constructing a balance sheet in a while, and I want you to note that a balance sheet by definition must always balance. What that means is that the total asset side should always be equal to the total liabilities and total shareholders side of the balance sheet. In order to make sure that that's the case, accountants have to develop a system of recording transactions on two separate places, which is known as double entry accounting, which ensures that the balance sheet is always working. And there are two options for doing this. The first option is to record any transaction on both sides. For example, if a company uses cash to pay down debt, the asset side of the balance sheet goes down on the cash balance, and the liability side of the debt owed also goes down by the same amount. So the balance sheet will still balance. And the other option is to record a transaction twice on the same side of the balance sheet. For example, if a company uses cash to buy an asset, you will record it twice on the asset side. Cash will go down as an asset, but the equipment that has been purchased makes the asset goes up. So cash has gone down, but the equipment purchased makes the asset goes up. So the balance sheet is still balanced. This was all you needed to know about the layout of the balance sheet and the double entry method of recording transactions. If there's anything you feel should have been included in this video which I did not, feel free to let me know in the comments. Thank you for watching. Stay happy.